Charlotte McLeod with the Investing News Network, and I'm here today with Nick Hodge, founder of the Outsider Club. Thanks so much for joining me today.
Always good to be with you, Charlotte.
Yes, and we're here right now at VRIC. It's the first day of the show, and you did a presentation earlier today. You talked about kind of the basics of investing in gold. Can you tell me why you went with that topic?
Yeah, sure. At the last Cambridge show in October in San Francisco, I talked about why to buy gold, and we covered all the boring stuff like monumental world debt and interest rates and the lack of investment in gold over the past 10 years and why majors needed to reinvest in development and exploration and why capital was due to come back in the sector. And I'd like to think that presentation was spot on because since October, the stocks that I talked about and gold itself has gone up quite precipitously. Gold from 12 something to 1300 and the gold stocks that I mentioned some 20 or 60%. And so that was the why, and then since then I've been getting some emails, either from readers of my newsletter or even from some strange colleagues and even friends from high school and things like that, talking about or asking me, what do you mean when you say buy gold? Do you mean buy gold bars? Do you mean invest in gold stocks? And so to me, as a contrarian investor and a trend seeker, I view that as saying. It looks like people are ready to come into the space that aren't currently in the gold space, and that is what is truly needed for a gold bull market. I can buy gold until I'm blue in the face, and everybody in this room can buy gold until they're blue in the face, but they're the people that have already been buying gold for the past 2 decades, and so you need new blood. You need new capital to come in to truly propel the gold price and the gold stocks higher. And when people that don't invest in gold start asking me how to invest in gold, I view that as a precursor, and so I just took that as an impetus to present some very base level facts and insights on how to invest in gold, really from soup to nuts, from bullion all the way to high-risk explorcos.
And what is your advice for somebody's portfolio? Obviously, it's different from person to person, but how should you break that down?
Yeah, it's different from every single person, and I'm not a financial advisor, and so I'm not going to give financial advice, but the common rule, the age-old rule is 10% of your portfolio, half of that in bullion, half of that in gold equities. Now you can scale, right? If you're a wealthy individual and you're a speculator by nature and you speculate in the space, you're going to have a much larger holding of speculative positions. If you're an older person that's much more conservative, that is not looking for capital appreciation, but rather inflation protection, you want to own less gold stocks and more gold bullion to protect your savings. And so everybody is different. The general rule you'll hear parroted is 10%, half and half.
Okay, so you mentioned there's these new people who want to come and buy gold. What do you think is driving that interest?
That's a good question. One, I think, is the Bitcoin and the crypto phenomena that has happened over the past, call it 3 years. So just an anecdote. In my office, there's some 50 individuals. I would say the average age is less than 30. At the height of Bitcoin mania, call it October a year ago, incessant talk about buying cryptos in the office. We're getting rich, Bitcoin's going to $1 million, Ether's going to go even higher, it's replacing the fiat dollar, and the fiat there is important. And we're going to supplant the monetary system, us 25-year-olds. And clearly that didn't happen. But what did happen is it got them talking about fiat currency and the fact that the dollar is backed by nothing. And so I think crypto was a good educator into why the dollar isn't as almighty as some people think. And it got them talking about fiat. So that's one thing. 2, it's back in the headlines, right? It just hit $1,300. Newmont has bought Goldcorp. Barrick has bought Randgold. Those are multi-billion-dollar acquisitions that hit the homepage of Bloomberg. And when gold's on the homepage of Bloomberg,
Okay, and those deals, that's big news.
That's right.
What do you think about the most recent one or both of them?
Yeah, well, everybody's talking about it, and that's the first point, right? It gets everybody talking about gold, and that's really the most important takeaway for me. I'm not a big follower of the major companies. I cut my teeth mostly on development stories and exploration, but what it does is it gets people talking, and it says, hey, there's obviously M&A and consolidation activity happening in the gold space, and that's a sign of a precursor of more activity to come. And also it says to the management teams, you better get off your keisters and create shareholder value. Otherwise, the Canadian companies are going to continue to go bye-bye because they're weak.
Okay, so a lot of people are saying we've seen these big deals, we're going to see more mergers and acquisitions going forward. Do you see that? Do you see other trends in the gold market coming?
So I think the first point for me would be that these mergers and acquisitions are giant deals. They're not going to be closed for months and months and months, if not years. Lots of accountants and lawyers are going to get rich. It's a lot of paperwork. It's a lot of merging of assets, merging of management, merging of offices, merging of auxiliary staff, and that takes a long, long time. So I'm not sure they're going to get back to deal making just right away because their eye is on the merger ball and not the acquisition ball. But what I will say is they're going to have to shed assets. Some of their non-core assets, as we've already seen Barrick Randgold do this. Randgold came in and said, look, anything that we don't think is going to be a tier 1 mine or a tier 1 asset, we're going to sell. It's not going to be a part of our core focus. And so what happens when majors have to sell those non-core assets is companies that are here, the development companies, they come in and they buy those assets and they start developing them. We call these brownfield development plays. And so I think you'll see deals in that respect. Those major companies shedding their non-core assets, development companies coming in to redevelop those.
Okay, that's good. So are you feeling good about gold this year?
I always feel good about gold. I'm not a gold bug, but I think that gold is real money, and so I always feel good about gold. I felt really good about gold at the turn of the year. It simply got back down from 1,300, and so it's tough to get excited when we keep getting swatted back from 1,300, though I will say it didn't pull all the way back to 1,250. It's holding up nicely, 1,285, 1,290, and so feels better than last year. I'll take it.
Okay, sounds good. So that's gold covered pretty well. We also usually talk about uranium. Last year we saw kind of a steady price increase. Will we see more of the same this year?
I don't know. The spot price seems to be stuck. I get a daily update. It seems to be stuck at about $28.90. It hasn't moved really in a couple of weeks. Call that laziness around the holidays. Nobody's buying and selling uranium. What we're all waiting for, and I think I might have told you this before, is for the utilities to come back in. Everything now is in place. Cameco has cut. Kazakhstan has cut. Section 232 is making its way through. Prices have fallen down enough that nobody is incentivized to produce. And so all those pieces are in place. The last piece is waiting for the utilities to come back into the market. I think, as I might have told you before, we're expecting that in 18 to 24 months. And again, there's no rush for them because they don't care how much they pay, because the price of the uranium is such a small part of running a nuclear reactor that they don't care if they pay $40 or $100 a pound. And so I would say wait for the utilities. That's what I'm waiting for. But at the same time, you have to be in the market because when it turns, it's going to turn fast. And so start placing your bets, I'd say.
Okay, and we know that the prices have to go higher for companies to come back online with their production. There's some that have shut down. How much production is there waiting in the wings to come back right now?
Well, I think there's millions of pounds. McArthur River, was one of the highest grade uranium mines in the world, and Cameco just shut it down. So that's now on care and maintenance. That is waiting to come back on. And there's a lot of large projects that could be put into production. I'm talking about, multi-100 million pound deposits in the Athabasca Basin controlled by companies like NextGen and Fission. What I think you'll see first, and I'm parroting Mike Alkin a bit here, is you're going to see the low-cost African producers come back first.
Okay.
People try to, and I in some cases have poo-pooed Niger and Namibia in some cases, but the fact of the matter is they've been in uranium production for half a century, and they have assets that can be turned on quickly because of less regulatory red tape that we have to deal with as industrialized first world nations.
Okay, yeah, that's kind of what I was getting at, is where, if you're an investor, should you be positioning yourself? Is it in companies that will bring their assets back online, or new companies that are, I guess, waiting with things?
Yes.
Yes,
because it's not like gold, and it's not like base metals where there are thousands of companies.
Okay,
I think less than 10 companies produce, 90% of uranium in the world. So you can almost make yourself your own little ETF and buy a little soup to nuts uranium package for yourself, where you have some producers like, Cameco or Paladin, and then some, larger market cap developers like Denison, all the way down to the explorers, which will give you the most leverage.
Okay. Other commodities where you see opportunity in 2019, since we're at the beginning of the year?
Everything is getting electrified. That trend's not going away. There's over 7 billion people. That's not going away. There was, less than half that in 1900. So we're a breeding population. We need copper. It's It's been soft, but it's the same story with many of these commodities. The copper price has been low. We need higher grade copper projects now to come online, and so I think keep an eye on copper. But no, I think when you get a resource bull market, you're going to get a resource bull market, and all the turkeys are going to fly.
Okay, and you cover a lot of things that are not commodities. Where are you looking outside of the resource space?
Outside of the resource space, cannabis is still interesting. The U.S. hasn't legaled yet. States are starting to go state by state to legalize, including some bigger states. I think Michigan just went. I don't like tech. I'll tell you something I don't like. I think it's finally time for a FANG correction. Netflix is looking weak. They had a pretty terrible earnings report this week. They had to raise their prices, and so that's a bit of a tell. And I just think generally the FANG stocks are due for a correction. And if I have to truly tap my contrarian core, no one's making money mining Bitcoin at the current price. So I've kind of been negative on Bitcoin for the past 2 years and telling people not to buy it, not to buy it, not to buy it. It was proven correct, but it's getting unloved enough that it might be time to buy it again.
Okay, interesting. As we wrap up, what's your best piece of advice for investors this year?
Best piece of advice for investors this year: stay the course. Do things that are age adjusted. I can't tell you what to do based on your age. I'm 35 years old. I still own a lot of stocks. If you're 60, 65, 70, you need to be lighting up on the stocks, and this is traditional advice going into the bonds. But I would say stay the course. We're going to see volatility. We saw a 15, 20% correction in the S&P. If you're under 40, you can't be trying to time the broad market. Stay in your mutual funds. Keep your 401k or your IRA or whatever it is untouched. Leave it, let it grow. It's proven over time that's the best way to invest for the long term. And then take your speculative shots with well-researched information. Okay,
well, thank you so much. I think we'll leave it there. But once again, I'm Charlotte McLeod with the Investing News Network, and this is Nick Hodge of the Outsider Club.